Basically, I'm trying to put before you the reason for the alternate approach developed by the UN Tax Committee in a very simple manner, because there may be people here who may not be very familiar with exactly the tax, how the tax rules work. So there was a problem about taxation of digital economy, as my colleague from the UN Tax Committee, Carlos Proto, in the beginning highlighted. Now, this is going on for some time, I would say at least for 20 years. And there was a challenge to taxation, and there was the issue of contribution to domestic resource mobilization for developing countries due to digital economies, which are not amenable to the current international tax rules of permanent establishment, of a fixed place of business in the market jurisdiction, or an agent's presence. So therefore, the debate started and discussion started. And I have listed here 4 major issues which have been at the center of this debate. So first one is whether to tax. Now, the question is whether to tax. Quite a bit of time has been spent on whether to tax, but I would say that this is one major outcome or achievement so far, that everyone, including the other forums which are working on this, are now in agreement that there should be tax. So this major issue, I would say, has got settled, which was unsettled for very long. Now, next question is what to tax. Whether we should tax services rendered through digital means, internet or other digital networks, or we should tax goods also, or we should tax all of them or some of them. And then there was related issue of ring fencing. So this is what I have put under what to tax. How to tax? Now, this is with reference to the 2 possible approaches which we are looking at this time. One is the centralized approach, where M&E-centric approach, total profits of the M&E group will be pooled together, and then they will be allocated to different countries and with subject to certain rules. And the other is traditional approach, where, like we have been doing for a permanent establishment so far of a multinational in a country, and each country calculates what is its share of profit based on a nexus of permanent establishment. So can we follow that approach for this new challenge or not, is the issue I am trying to refer to when I say how to tax. How much to tax? How much to tax is a very important aspect of this whole exercise, because ultimately the proof of the pudding is in eating. So unless you get something, what is the point in all of this exercise? So there the question is whether to tax only a portion of non-routine profits or something else, then which my friend Carlos Proto described in detail. Now, next issue is measurement, how to measure this. Even if we say we want to tax non-routine profits, how to measure them is an issue. And how to measure them accurately is the issue, more important issue. So as all of you must have understood from the presentation made and from your reading of the various proposals, it's not possible to measure this accurately in any manner when there are no accounts in the market jurisdiction specific to that jurisdiction, and there has to be an approximation. So both the other approach as well as the UN approach goes by an approximation. So one cannot say one is superior or other is superior in the process of measurement. It would ultimately be the ease of measurement that would matter here, and that one should keep in mind. Moving on. Now, why an alternate approach was needed? We already had intensive discussions going on elsewhere, and the UN Tax Committee, why it should look at an alternate approach. So the primary reasons for this are 2. First is complexity of the proposals that were under discussion, and the members in the UN Tax Committee felt that there was a need for an alternative approach. At least some of them, and quite a large number of them, felt that there is a need to have a different approach, an alternative approach. Second was the most important aspect as to what we are going to get out of this. Ultimately, any solution that is agreed to has a long shelf life. We all know that tax treaties take years to get changed. Any international solution will be there for some time, a time horizon of 20 to 30 years. So one should be very careful in what we are going to get out of that. Otherwise, this is going to be fixed, and it will leave one fixed with that, which cannot be changed. Next point is, now I would turn to Article 12B, which all of us know about, but not so much perhaps. So first, I will just briefly mention about the United Nations Tax Committee. What does it do? The United Nations Tax Committee is a committee of experts in their personal capacity taken from 25 countries, and both developed and developing countries. Its mandate is to work in interest of developing countries specifically. Tax challenges of digitalized economies was taken up as a work stream for the present committee when the present membership was constituted in the year 2017. Now, the issue there was whether to just observe what others are doing or should we do something more. We consumed quite a bit of time on that. There was a long discussion whether we should only look at what others are doing. After that, due to persistent push by some of us, in the 18th session, we took a decision that we will work independently and will not be mere observers. And we will take into account the work done in other forums. And then the question was, how would we work independently? It was because, it's a 25-member committee. Each one has a different view. So there would never be a consensus. Consensus is a difficult thing. 25 members will never agree to one thing. So how would it progress? Then a proposal was made that we should have proposals from various members invited or a group of members, and then see whether those can be adopted by the committee or taken forward. In 20th session in June 2020, we had a paper, conference room paper number 25, in which I had submitted a proposal. Prior to that, my colleague, Mr. Jose Troya from Ecuador, had also submitted a proposal, and those proposals were discussed. And it was decided due to the interventions by the developing country members, including myself, Carlos Proto, Jose Troya, and several others, that there is enough merit and enough reason for looking into the proposal submitted, and a drafting group was formed to work and draft an article for insertion in the UN Model Tax Convention. Then in the 21st session, we put forward the drafting group, of which myself and Carlos Proto were the co-coordinators. We put forward a draft of the article and commentary. It was discussed extensively amongst the members, and it was continuously refined. And in 21st session, by vote, it was voted for in principle approval for inclusion in the UN Model Tax Convention. That was in October 2020. Thereafter, the refinement of the text and the commentary continued, and finally, in 22nd session in April 2021, it has been finally approved for insertion in the UN Tax Convention. Now, let me briefly talk about why this is also a part of the alternate approach that is being talked about. Why modify tax treaties? The UN solution is an article in the UN Model Tax Convention purely, and it is going to be there in the Model Tax Convention. The reason is that taxing rights flow through the domestic law, and then treaties are there, bilateral tax treaties, which override the domestic law. Treaties do not permit taxation if there is no permanent establishment, as we discussed. Therefore, there is a need for treaty modification. And the gain in that process is elimination of double taxation, because through a treaty, if it is in accordance with treaty, the taxation in the market jurisdiction, the other country will also give credit for taxes paid in the market jurisdiction. Now, what is the role of UN Model Tax Convention? What did we achieve by putting it in the UN Model Tax Convention? Now, the treaties are negotiated all over the world based on two conventions, the United Nations Model Tax Convention and the OECD Model Tax Convention. So these have persuasive value on various countries across the world for negotiating their bilateral tax treaties. Therefore, if an article of this kind gets inserted into the United Nations Model Tax Convention, which is followed by developing and developed countries, then it has a persuasive value, great deal of persuasive value, and countries can probably adopt that into their treaties tomorrow. So that was the objective for putting it in the United Nations Model Tax Convention. Now, what are the features of Article 12B? Briefly, I have put them here. I'm not calling them pillars, but these look like pillars to me. And the first one is, what is the scope? So the scope is automated digital services, which covers a whole lot of services which have been talked about since beginning for taxation under this area. Whenever there was a talk, it was referring to these services which we have tried to cover here. Now, the taxation is under the article is on two, can be in two ways. The first is a gross basis withholding tax at a rate of 3 to 4% recommended in the commentary, and which is a very reasonable rate. And second is a net basis option. Why there is a net basis option? Because there could be MNEs or enterprises which may not have profits, which may have losses. So they should have an option to go to declare their income on the basis of their actual profits. Actual profits are not measurable, I said that. But the way they have been computed, they take into account the overall global profitability of the MNE group enterprise. And the profits are 30% of a sum, which is calculated by applying the local revenue to the global profitability of the MNE group. Payment basis, instead of a user basis, we have chosen payment basis. There are several reasons for that. In this short seminar, I'll not go into that, but I wanted to list that as one of the major features of Article 12B. Interaction with other articles. The article, obviously, here we are talking about one kind of income taxation. And as is the case with other articles in a tax treaty, there could be an overlap with other articles, for example, with business income article, with royalties article, with fees for technical services article. So those are taken care of and by clearly specifying which will prevail in case of an overlap. So that is also done. So I would say that Article 12B is a code in itself, self-contained code, which provides a solution to this vexed issue of taxing the digital economies. At this stage, someone may say why we did confine ourselves to automated digital services. The reason is very simple. There may be a ring fencing question there somewhere, but at the same time, we are not saying that we are not going to provide, we exclude providing solution to other issues. We have at this stage provided a solution to one major segment of which was of concern to the world. Coming to the conclusion, and these are some aspects which I would definitely like to tell you. First is that there is no suggestion to tax digital businesses, which is a matter of domestic law exclusively. What I'm saying is that Article 12B will come into play for a country which has chosen to tax digital businesses, as has been the case for taxation so long in respect of any kind of incomes. And if you look at that, it has been like that. Second is no interlinking with other issues. This is a standalone basis solution. It would be clear that we are not mixing up other problems with this one. We are only confining to a principled solution to a problem which was actually there. And I can see only this as the problem which started the whole discussion and debate. So this is what we are trying to provide solution to. Traditional approach for M&E taxation in a decentralized manner, a very important point, because our Article 12B is similar to Article 5 read with Article 7, to which the countries are used to, especially the developing countries. So what they are not to make any major deviation from what they have been doing so far. And they can simply take one more step ahead and get into the Article 12B mode and start doing it. Implementation, bilateral negotiations, and multilateral instrument. This is basically how to insert Article 12B in the treaties. And therefore, there was in my paper, which I submitted in June 2020 meeting, I suggested then also that there can be a speedy insertion of Article 12B, swift manner in all the tax treaties if there is an instrument of like MLI, and countries can sign it, and then it can get inserted in their bilateral tax treaties. Possible end to unilateral measures, equalization levies, and DST is a very important point, and my own thought about this. I think that if you look at the DSTs all over the world, the equalization levies about which so much talk is there and so much of concern is there, because they are kind of circumventing the tax treaties, and for them the tax credit is not available. Those are the concerns. Now, why was that done, even though on recommendation of BEPS Action 1? Because otherwise it was not possible to tax them. Now, I think if Article 12B is inserted in the treaties and these taxes are slightly remodeled and they are made covered taxes under the bilateral tax treaty, which has an Article 12B, then this automatically will take care of the equalization levies and DSTs of the world. And at the moment, I see those are the taxes which developed as well as developing countries have imposed. So this is another feature of Article 12B, which I find to be a plus. So with that, I come to the end of my presentation. I hope I have not exceeded my time, Abdul. Thank you very much.